I think it's an interesting dynamic. The bulls are out saying, look, Fed fund futures are predicting, rate cuts next year.
Right.
Well, why would they cut rates? Let's think about this. Only if the economy was sucking. That's a technical term.
Mm.
So otherwise, why would they cut rates? What I think people are confused by is most market participants today grew up in this era of craziness, right? Zero interest rates.
Right.
And they think that's normal. It's not normal, right? We had a 10-year period following the global financial crisis, and we had about a 7-8 year period in the late 30s and early 40s. That's it. The rest of the time, rates average somewhere between 5 and 7.5% on the short end. Look, I don't think we're going back to emergency liquidity measures, right? I don't think we're going to have another emergency like the global financial crisis. I think we're going to have a pretty meaningful slowdown. PMIs have rolled over hard. Employee or consumer confidence has rolled over hard. There are a lot of things that are pointing to much lower economic activity next year. And I think that may push the Fed to act. I don't think they're going to act very much because I don't think it's going to be this big deleveraging like we saw in the global financial crisis. We had the third largest bank failure in history earlier this year with Silicon Valley Bank. And people brushed that off like it was nothing. Now the Fed, threw $300 billion, but as one of our managers, Chase Coleman at Tiger Global, said, it was inconvenient for too many people for those stocks to go to zero. So they didn't go to zero. And by saving them, by bailing them out, by giving them $700 billion of taxpayer money to bail them out at the bottom, then we had to reliquify their balance sheets. Well, how did we do that? Well, you let them borrow from the Fed at zero. Because I don't know about you, but I never got to borrow at zero. Fed funds, I don't get access to that. So it was only the banks. The banks borrowed at zero and they bought treasuries. And that was a great trade. You made 3% risk-free and you could lever it up 10 times and have no down trading days. But then Jerome Powell comes along last year in 2022 and says, party's over. I'm raising rates. And so all these banks that got stuffed with those bonds, well, what changes every November? So there's a rule that happened back many, many years ago that changed the fiscal year end for mutual funds. So they used to trade on 12/31 year end, and then they changed it to 10/31. So mutual funds have to unload all their trades before 10/31 in order to qualify for the current tax year. Well, why does that matter? Well, in the old days, all the tax loss selling, all the bad stuff that happened would get liquidated at the end of the year.
Right.
And then there was this thing called the January effect, because you have to wait 30 days to buy back the thing that you just sold. And so everyone would unload in early to mid-January, in December. Then they would buy back in mid-January. And the worst performing things the previous year would do the best in January. And it was usually small cap stocks, and they called it the January effect. Data. How are the airports? How are the hotels? How are the airplanes? Are they still full like they were in the summer? Are they starting to be empty? I was talking to someone the other day, said they're on a plane with 20% full. 20%. When was the last time you were on a plane with 20% full? I mean, that's different. Restaurants, not as full as they were. So there's signs of slowing. We just had retail sales fall for the first time in 7 months, and 7 of the 12 sectors were negative. So there's signs that things are starting to be down a little bit. And the thing that I look at is the only way people were still spending in this environment was credit card debt. right? So everyone termed out their mortgage, and that was great. So now no one can move. So we've got the lowest turnover in housing in the last 100 years, sub 1%, because no one can afford to move.
Right.
So if you can't, but you have a lower mortgage payment, so you feel a little more flush. So then they went out and spent that over the summer. And so, that's a problem. And I just think, can the Fed turn the money printer back on in a world where there's too much money sloshing around?
Sure.
I don't know. I'm going to take the under. I'm going to say that rates are going to stay higher for longer. Things are going to get slower for longer. Not a disaster, not a depression, but slower. Kind of like the 01-02 period, where it was pretty ugly. A lot of companies had to default. Bad companies went away because they couldn't refinance their debt. That's good. It's healthy. The period of time post-global financial crisis where every company was allowed to survive, that's not healthy, right? It's like having no cuts. That approval is going to unlock $30 trillion of assets in financial advisors who are not allowed to buy digital assets. And if their clients say, I want 10 basis points, that's 30 billion. If they say, I want 100 basis points, 1%, which is not even a lot, that's 300 billion. Bitcoin trades about 100 billion on average. About 600 billion is mostly hodled. So if 300 billion comes in on 100 billion of free float, that's a big move. From there, you've already seen a lot of things catch a bid. Solana's on a tear here. Ethereum's been rallying, still lagging Bitcoin, but it's been rallying. And ultimately, the halving cycle is destiny, right? When the halving cycle occurs, and the halving occurs next April, but in crypto fall, on average, we've rallied about 2.5 times fair value. I don't think that happens this time. I think partly the law of large numbers, partly not as much leverage in the system. So, do we get 1.5, 1.75, 150, 175? Maybe we could get to 200K. I'm going to take the 150 number. Seems like a logical place for us to be sometime in 2024.
Wow. Okay. But that was going to be my next question. If you anticipate that's going to happen in 2024 or 2025, just, following the 4-year cycles. So it sounds like 2024, and we started the correction maybe in 2025.
Yeah, look, June 25, we likely, or fall 2025, logic would say we get too high and then we correct. And why do we get too high? Because the speculators come in and the gamblers come in and people lever.